Well, today I wanted to talk about recent developments in the markets, my view on central banks, and of course Australia's spectacular GDP report that was released today. We've seen a lot of volatility in the markets. Westpac has been blamed for some of that actually, because on the 19th of February we significantly raised our forecast for the 10-year bond rate to 1.9% by the end of 2021. And we had a long-term target of 3.25%. That 3.25% is made up of 2% for inflation, giving credit that the central banks will eventually achieve their objective. And the markets are pretty much already priced that 2% into the bond rate. But 1% in real bond rates, and we've seen since the GFC, that 1% is typically where the real bond rate settles, particularly when quantitative easing has been scaled right back. So for 2% inflation, 1% real yields, and for somewhat of a margin over the US, we got a target of 3.25% by the end of 2024. The rate has moved to 1.9% very, very quickly, scaled back to 1.7%. But we think that eventually the markets will settle down to more reflect those longer term fundamentals. However, I don't think that central banks are necessarily watching closely and developing their policies around what's been happening on the bond market at the moment. I think we have to remember that in this cycle, central banks are going to be patient. They're not going to be preemptive. They're going to wait till they achieve their targets and ensure that those targets have been sustainably achieved. And then they'll probably start to move on policy. At the moment, of course, the Reserve Bank confirmed that view yesterday when they said they will not be raising rates until they see inflation sustainably between 2 and 3%. And that's likely to be consistent. They haven't used those words yesterday, but they tend to use it in the past, with wages growth of between 3.5% and 4%. And they don't think that that'll be achieved until 2024. This comment was made even after we'd seen the big sell-off in bond markets. So I think it's very important that what will be driving the central bank's thinking will be their forecasts. It'll be where they see the timing of when they achieve those targets. And of course, a big input into those forecasts we saw today with the December quarter national accounts. The market was expecting growth in the quarter of 2.5%, and the number printed 3.1%. And most of the surprise was around the consumer, 4.2% growth in the consumer. Outside Victoria, growth in the consumer was 2.2%. So you can see that the reopening of Victoria in that December quarter, which led to around a 10% jump in consumer spending in Victoria, was the key factor driving that consumer. Now, we also assess that about $30 billion was drawn out of the economy by the government scaling back its stimulus package in the December quarter. So, and that led to a 3.1% fall in disposable income growth. But of course, strong consumer spending when disposable income growth is falling was funded by a drawdown in accumulated savings. We estimate that in the June and September quarters, household savings lifted by about $200 billion. That reflected in a savings rate of over 20% that fell to around 18% in September. And now it's fallen to 12% in the December quarter. So all of this pickup in spending has been due to the consumers and households using that accumulated savings. Westpac is not surprised about that because we've been reporting 10-year highs in consumer sentiment. In December it reached that level, and in February very close to that level. And I have to say it was the Westpac Consumer Sentiment Index way back in May, June that was the first signal that we were starting to come out of the deep crisis that we saw in April, May. So how will the Reserve Bank look at this strong growth story? The economy contracted by 1.1% in 2020. The Reserve Bank thought it was going to be 2%. That's good news. But at the beginning of 2020, before we'd thought about the pandemic, the growth for Australia was expected to be around 2.5% to 3%. So contracting by 1% means the output gap is expanded by 4 percentage points. It's going to take some time for that output gap to close. And while that output gap is wide, particularly this year when population growth will only be 0.2% compared to a normal 1.5%. So in order to get above trend growth, consumer spending per capita is going to have to be around 5% plus. Very, very strong ask. We've seen that happening already, but as that savings rate starts to come down, it's going to become more of a challenge. So that output gap is going to be quite wide for quite some time, and that's going to provide that downward pressure on wages and inflation. It's going to find it difficult for the Reserve Bank to see a way to achieve their objectives. However, depending upon how they interpret the GDP report today, and depending upon how the economy evolves over the next 3 to 6 months, the Reserve Bank could easily start to revise the timing of that first rate hike. It's going to depend upon the data. It's not going to depend upon what's happening in those financial markets. Thank you.